these two groups, or maybe in the middle. For example, maybe your investment is more aggressive. You want to earn abnormal return. You want to earn beyond Dow Jones Industrial Average return. You want to earn beyond ETF return. Like in Taiwan, you want to earn beyond the Taiwan index return. It's more aggressive. And if you adopt offensive approach, probably normally is like a more concentration. Maybe you just more focus on a few stocks. Maybe 1 or 2 stocks, maybe 5, maybe 10 stocks. And these 10 stocks probably accounting for 80% of your portfolio. And once you form the portfolio, just my experience, different people have a different. My experience is probably I'm going to use 20% of my portfolio to do the short-term trade. But the remaining portfolio will be for the long term. The long term, actually, some of my stocks, the long term is even more than 5 years. But even say, hey, Professor, you say you are very speculative. I think it's more like the 20%. It's more like short term. But for most of portfolio, it's long term trade. More concentration. And so it's more concentration, the object of diversification. The diversification is more like a defensive. You can diversify those unsystematic risks. So maybe you have the portfolio maybe more than 20%, and more than 20 stocks or maybe 30 stocks, and then you try to the different industry and try to diversify. And also, if you are taking a offensive approach, you may use leverage. Normally, you want to make money for your investment. Probably I should say making profit rather than money. Money looks like a very sushi, not very professional. Okay, so you want to make profit. Leverage is one way. The other is from undervalued stock, right? This is called value investing. You want to find you evaluate the intrinsic value of a stock using our model. You will learn in the class, right? Like net present value or like PE ratio, etc., EBITDA, etc. Then you check the intrinsic value with the share price. If the share price is below intrinsic value, probably is considered to be the value stock. So you invest in value stock, then you hope the share price will reflect the intrinsic value in the future. So this is the second way. The third way is you want to invest in the growing stock. Although now the price is not cheap, but you anticipate, evaluate, going forward, the company, their customer base will be broadened, and they will introduce more investor or consumer to their product, and they will lower down their cost. So you think that their cash flow and profit will increasing. So you want to make an investment. Like I think in January we found there are 2 stocks. Their share price, after they make an announcement, the share price increased significantly. One is Google, not Google, Amazon, right? because Amazon, their cloud computing business profit margin was increasing. So their share price react positively. I'm talking about when they make announcement. Now the share price also down because of the systematic risk. And the other stock is called Netflix. Netflix is a good stock. But Netflix, in January they make announcement. Their share, because their customer acquisition is declining, not increasing. This is very serious for a company like Netflix, because now they already have 200 million customers. Another customer, 200 million. You know, in my another class, like business strategy, right, and entrepreneurial finance, we talk about, because our case, we discussed in year 2011. In 2011, they only have like 20 million customers. But now they have 200 million customers around the world. So such large customer base is difficult to go higher. So their growing rate is not negative, but it's slowed down. So their share price, I think the share price dropped almost 20%. Facebook as well. Facebook, since they make announcement, their share price has dropped already 35%. So if you are taking the offensive approach, concentration, and focus on growing stock, and leverage, probably two examples of offensive. Offensive not necessarily mean you always invest in the growing stock. Maybe you also can invest in the value stock, but you are more concentrated on those sectors. They will add to return when they work, but prove harmful when they don't. Okay. And the other approach, investment strategy, is defensive. Can be seen as an attempt at a higher return, but more through the avoidance of minus than through the incursion of profits. And the more through consistent but perhaps moderate progress than through occasional flashes of the brilliance. So two principal elements in investment defense: to exclude the loser from portfolio. This is the best accomplished by conducting extensive due diligence, applying high standards, demanding a low prices and a generous margin for error, and being less willing to be on continued prosperity, rosy forecast, and the development that might be uncertain. And the second principle is the avoidance of poor year and especially exposure to meltdown in crashes. Investment defense requires thorough portfolio diversification, limits on overall riskiness form, and the general type and total safety. So this tells you about principle. You know, the investment is difficult because the textbook or the lecture always tell you about principle. But the problem is how do you decide is a poor year or not? Right? I think the US stock market has been rising for more than 10 years. I think since year 2015, a lot of investor master, very active investor, professional investor, they always mention the US stock already it's going to be the bad year. It's going to be the poor year. The reason is, in the investment, we always know when the share price already very high, that's a bad news, because the next day it's going to fall, right? When the share price is down to a bottom, the probably is going to be good news, although it's still declining, because already low already. Remember, in the Taiwan market, if you take a look over last 30 years, when the Taiwan index dropped below 10 years average, 10 年线, 10 years average, you make investment, you hold it for 6 months, probably are going to make at least 20% return. It's always, right, for the last 30 years. And that's one signal you can watch is, in Taiwan, because the Taiwan market is really influenced by the political situation between Taiwan and China. So we have formed I think the 25 years ago, we formed a money pool we call National Security Foundation, 国安基金. This means if the market irrationally drop, the government is going to use those funds to sustain the market. So remember, whenever the share price is going to drop to below 10 years average, before drop to 10 years average, the National Security Foundation, they are going to, they will have a meeting and talk about it, always express their positive about the stock market, express the fundamental is good, and the government supporting the economic growth is something like that. Try to, then also they are going to go into the market. And every time they go into the market, then this fund making fortune, making money. Okay. So 10-year average is, but probably for a lot of investors, when the share price drops to the 10 years average, you don't have money, right? All your money in the portfolio. So your portfolio is dropped to less than 10 years average. That's a problem. So it's good investment, especially in professional investment. You are not going to invest all your money in the stock market when the stock market is good. Probably you will reserve some cash on your account. Maybe 20%, maybe 30%, maybe 15%. Just unless in the market irrationally drop, probably it's a good time for you to buy very cheap. When the market drop less than 10 years average, actually there's a chance for some people wealth transfer. Some people will become bankruptcy. Some people, especially when you have all your money in the stock, and some people they have cash, probably they're going to take advantage of the stock market downfall. Even in the U.S. as well, remember I talked in the last class, talking investment banking class, during financial tsunami, the J.P. Morgan, one of the largest investment and commercial bank in the U.S., before financial crisis, they sold out 80% of their supply holding. Supply, you all understand supply, right? 次贷证券. But companies like Lehman Brothers didn't do that. They still hold huge amount of the supply. So when the supply crisis in year 2008, Lehman Brothers get out, and J.P. Morgan acquired one or two investment banks in trouble. Acquired, so become bigger and bigger. So this so-called wealth transfer. right? Same to the individual. And also, you can take approach like in between. Maybe like a 30% offensive, 70% defensive. Maybe 70% offensive, 30%, maybe half and half. Balance between offensive and defensive. So invest in the offensive in addition to defense doesn't mean they should be indifferent to the mix between the two. If investors want to strive for more return, they generally have to take on more uncertainty, more risk. If investors aspire to higher return, then can be achieved bound. They cannot expect to get there through loss avoidance alone. Some offensive is needed, and with offensive come increasing uncertainty. So you can take it between. But investment is really facing uncertainty. Let's take example of nowadays. Nowadays is the inflation environment, at least, the first half of this year. So what investment strategy you are going to adopt? Are you going to invest half of money in the stock and half money in the bond? Or maybe 30% in stock and 30% or 40% in bond and reserve 30% cash? What are you going to decide to do? Difficult, right? Because stock market looks like very volatile this year. But how about bond? We learn from the class, right? Liao Jinghan, Wenli, Annie, right? When the year, the YTM, I mean year to maturity, increase, interest rate increase, the bond price is going down, right? Yes, yeah. So how about this year? This year is inflation year, interest rate is going to up. So it's a good chance to invest in bond. Theoretically, probably not, but who knows? Who knows? Maybe bond price is good. Hard to see, because if the stock market is so volatile, and money is still there, some investors they may switch their from stock to bond, put money to bond, or to gold, right? Or even cryptocurrencies. So although the interest is up, but bond price may be still up. Who knows, right? So I said it's all matter with liquidities. So investment is really, you have to take back, you have to take risk, and you have to make decision. So the reason for you to take this class, or maybe later on you take other classes, you want to improve, enhance the quality of decision, the quality of making decision. And the other concept I want to talk about is about the margin of safety, or margin of error. Same. Margin of safety, margin of error. Who want to tell me this mean? You have any idea about this? No. No? Okay. How about this side? Hey, you are not in my class last semester. Tomorrow, right? Tomorrow was in my class. But do you have any idea about this means? Melissa, any idea? I think most of PhD students probably don't know this idea. Sam, Liu Zhen, any idea? You make investment, right? Any idea about this? This is Sam, this is what? 另外一个叫什么？你们两个都坐在一起的。叫什么 ？Rachel. Any idea? If you don't understand it, probably actually the concept is very simple, but you just don't know the term, right? You just don't know the term. This term is from the book by like Howard Mark. Howard Mark, he formed a investment company called Oaktree. They are managing. I know I think the 2 years ago was merged, but they are managing. Even now, it's more than 100 billion US dollars. So it's pretty size of the asset management company in the Wall Street. Howard Mark, the author of this book, came to Taiwan several times. I met with him also 2 times. And because he has a client. No, I'm not his client, I'm just professor. He's a client like a Fubon family and the Koo families. But I have a chance to talk to him. He's very professional and he has some theoretical background because he got his master in the Wharton School. I think in our syllabus, we also listed his book. Here, the Chinese written book and also the translated book, also the English book. I think it's a good book to take a look. Here are 2 books. Actually, I read 2 books. Although after I reading his book, actually it doesn't improve my investment return too much. But actually, I learned something because it provides pretty good concept on it. The margin error is, the concept is very simple. That means you have to buy low, buy very low, share price that's very low, can provide you the safety margin. For example, like a TSMC in Taiwan, now the share price is about $620, right? But Gary, if the TSMC now is the $900 a share, would you want to buy?
No.
Probably not. Vivian, you want to buy at $300, right?
Yeah, probably.
Yeah. If you buy at $300, probably you provide you the margin of error. So the concept is very, very easy. Just you have to buy low. Okay. So here say how you will fare if the future doesn't operate. In short, what is let the next outcome tolerable, even when the future doesn't live up to your expectation. So like this example, you find something you think will be worth 100. If you buy it for 90, you have a good chance of gain, and with a moderate chance of loss in case your assumption turns out to be optimistic. But you buy it for 970 instead of 900, your chance of loss is less. Like $20 reduction provides a picture loop to be wrong and still come out okay. Low price is ultimate source of marginal error. The concept is easy, but how could you apply this? Let's take example of TSMC. TSMC. 6 years ago, I taught investment class. I told students at that time the TSMC share price was about $150. It's lower than $300. And I told students I'm not going to buy this stock unless, based on this tool, unless it was below $80. Don't buy it. Who knows, now became more than $600. So the principle is easy. It's just provide concept. The problem is, what is the benchmark? Is it really under value right now? How about future? Maybe future will become very brilliant. So that's why I think we have to, build up our knowledge, information sources. I think information source is very important. When you go to real world, maybe some student will become performance manager, and some student may become like a financial consultants. The way for them to get the information, even Taiwan or Wall Street, probably they want to talk to the CEO of the target company, and they want to visit the company, have it's kind of due diligence to see what happened. But if your fund or your portfolio company, your asset management company, did not have a sufficient amount of the money, probably they are not welcome. If you are financial consultant, investment consultant, 在台湾叫投顾 ，you only just advise, but you don't have the cash on hand. That means you don't have the portfolio money to make investment. Probably not, they are not going to welcome you. If they are not welcome you, probably you cannot get the first-hand information. But even the more difficult part is, even you got first-hand information, but they may be cheating you, right? They may be cheating you. I remember, now I don't play golf, but long time ago I still playing golf. And from time to time I have the chance to play golf with some like the founder of the listed company or CEO of listed company. And sometimes they may tell you, our share price looks very brilliant, and we are going to have some revenue jump up in short period of time. But always I just keep very skeptical. Although we are like a friend playing golf, they shouldn't be cheating me, right? And finally, maybe 70% their share price even dropped further. I'm not saying they're cheating me. As the CEO, as founder, probably you not know very much about your company's share price movement. When I work in the company like a Changhua Telecom, actually I couldn't control the Changhua Telecom share price. So, I remember 5 years, 6 years ago, 7 years ago, actually it's like 10 years ago, the HTC, the cellular phone, Hongdadian, very popular, right? And the share price was more than $1,080. And I think there's one insurance company called Xinguang Renshou. The insurance, the chairman, Wu Dongjin, Mr. Wu, they are very, very big ways in Taiwan. And they have the dinner with the founder of HTC, Wang Xiehong, Mrs. Wang. They talk, and after this dinner, he came back to his company and asked his portfolio manager to buy. I think they buy about a lot of share, cost them about 5 billion NT dollars to buy the share， 就买好几千张宏达电，很贵。But now you know the HTC the share price. What is the share price now? Do you have any idea? HTC about 60. The lowest was 30. So this boss, insurance company boss, he lost about more than 8 billion NT dollars. It's really happened. So was prosecuted by our SEC, our security regulatory body, because the regulator got the inside information saying he make decision, not his portfolio make decision. The decision should be buying and selling should be by the investment committee rather than by boss, right? But that was by boss. So this boss was get rid of the chairman position. And Wu Dongjin 现在也不能当董事长。So what is the correct information? How to interpret the information is really bad. It's really difficult. Okay, this I just tell you about the liquidity is very important for all kind of investment, not only security, stock, bond, gold, or the cryptocurrency or commodity, etc. Let's take example. For example, in year 2013, the U.S. Federal Reserve continuously release information in order to reduce bond buying, and the market expect to shrink QE. It's like this time, they are going to reduce bond buying and shrink this QE. But at that time, they didn't mention about the interest rate hike. But now, this time, the interest rate is going to be high. How money was withdrawn at that time from emerging market and the commodity market, causing a shock in global security market and a slump in gold price. At that time, investors faced a lot of losses. Like this is the gold price. One critical point, let me tell you. There's one research, another research, even my PhD student, he did a research. Mr. Zheng is going to make a speech in our class. Mr. Zheng, he was the former research director of the Fubon Investment Trust. Zheng Kaiyi, my student. He did a research for his PhD dissertation. And they also have a similar dissertation topic in the US, in Taiwan, or China. They found since year 2008, there was the year of the subprime, right, financial tsunami. Since year 2008 up to now, when the market down, all the assets will down. Regardless you are bond, you are stock, you are security, you are gold, you are even cryptocurrency. So what does that mean? That means looks like no really hedging instrument. Right? Hedging means if we expect the stock price is going to down, probably we have to buy bond, right, in order to hedge. But if the asset share price will simultaneously affected by the same negative factors, that means no sustained hedging instrument, right? Also, the study also show if since the financial tsunami up to now, if the share price up, all the assets are up. But because for those research, normally they use like a 10-year sample, maybe 12-year sample. But be honest, maybe that's on average. Maybe some year the correlation may be not correlated. Some year may be negative, some year may be positive. But on average, there was a positive. So when you read those kind of research, you have to be careful because it's just an average concept. And Ben, you understand what I'm saying, right? Okay, good. This is about the relation between the interest rate and the Standard & Poor's and the GDP. You can see this is the bracket. This is the yellow line is about extent, and this is about US GDP, and this is about interest rate. So you can see the GDP is really up and down. But still positive. So the share price is up. But more influential factor actually is interest rate, right? You can see the relation, right? When the interest rate slowing and going down, the share price up. So that's why I say the liquidity matter. But I'm not saying the economy focusing is wrong. No, it's still important. That's basic. But liquidity actually is killer, is more important. This is about 10 years Treasury constant maturity. Like year 2002, there was 6%. Now, it's about, now listen, since the last year is up, that's because the inflation expectations. So 10-year interest rate is about 2%. And some investor or some investor master in Wall Street, they worry about the 10-year interest rate in the next few years, maybe up to like 6 or 5. It's debatable. Could you believe that? It's really hard to, What do you think, Ben?
I don't think so.
Why?
I think this interest rates rise now because they tackle inflation, but as soon as the economy isn't that hard anymore, I don't think the interest rates will rise. I think we will have a situation where they will likely to fall again, and then we have actually in the long term probably lower interest rates permanently. So
I think in Europe is low interest rate for a long time, right?
exactly, or like Japan for example as well.
Japan is true, but do you expect for a long time the GDP growth in the US, in the Europe still low?
Probably yes. I don't know.
How
Hard
about,
to say. It's hard to say.
how about Germany? You know, Germany usually has the best performance in Europe, but I take a look at the last year number is not good.
It's not good. I think like nowadays Italy or France with like better markets with us in Europe.
Mhm. Okay. But I take a look at Russian economic growth last year is good, right? I think it's about like 4.5. Huh?
I'm checking.
You check. You don't have to check. Let me tell you, 4.5%.
Okay.
Right? How about your country?
I don't know, to be honest. I think it's 3.5, but I'm not sure.
You from Czechoslovakia.
Slovakia. We were Czechoslovakia before.
But yeah, I know, yeah, because Czechoslovakia and Slovakia are very nice to Taiwan. We feel it, yeah, right? Because during last year we have the trouble to get a vaccine, and I think these two countries, Greece, Greece one.
Yeah, our trade delegation, for example, was here, and like the ties since 2003 are getting much closer. Yeah.
Okay, good. So the 10-year interest rate now is the market closely watch this interest rate. Because if the interest rate rising, they will concern about the inflation expectation. Inflation is a matter of expectation. Expectation. The real number reflects something, but people more concerned about expectation. If you expect inflation is going up, it actually may be really up. So 2% is one benchmark. So you can see recent year, every recent day, whenever reach, if holding other factor constant, if no other factor like Ukrainian no action, if this rate more than 2%, probably the Dow Jones will drop, especially Nasdaq, because Nasdaq is the growing stock. Growing stock is more concerned about the inflation. And I want to ask you a question. Why growing stock is more concerned about inflation? Anybody want to tell me? Any idea? Growing stock. We already talked about the growing stock, like a Facebook, like a Microsoft, and like a Tesla, and Google. Whenever the market talk about the inflation, talk about the 10 years YTM, and their share price, if holding other factor constant, the share price tend to drop. Any idea what's the logic?
Because the volatility is greater than the value stock.
Okay, very good. 这不会
有
Bernice，投标滴滴的看。What do you think？ 啊，学投资学很棒的，好好学了。其实投资学，你们出去大概也没有时间学这个东西。It's a matter of an idea. You want to talk, Ivy? Yeah, this is good idea. It's very logical. Yeah, it's like this. The P ratio. Like a TSMC P ratio maybe like a 25 times or 30 times. And the company like Google, their P ratio is only 100. And some like Apple, the P ratio I would say like a 16 times or 17 times. So depend on you are manufacturing or you are internet company. Internet company or biological company tend to have a high P ratio. So P ratio, if the P ratio is 20 times, or maybe actually the growing stock is more than that. How about if the P ratio is the 50 times? If you reverse EP is 2%, right? 50 times, right? If you reverse, it's 2%. So 2% will compare with like 1 year. Mina, understand? Can you explain?
So if it's 2%, then it doesn't hedge the inflation?
If 2% and the YTM is more than 2%, then investor may think I should invest in the bond, 10-year bond, rather than growing stock, because the return is better there. So they will causing the money shift. So that's the logical. That's why they always say if the inflation expectation is because the will resulting in the YTM increase, they will causing especially the growing stock to drop. So this is the logic about this. Okay, so they care about the 10-year YTM. But now the 10-year YTM, I think the recent week, just 1 week, five trading day, dropped to like a 1.994 something. Why is dropping? Inflation, the Ukrainian still have the possible war against Russia. And you know the Russian produce a lot of the petroleum and petroleum related product, 天然气. So they will, if there are war, they were causing the petroleum price, oil price up. They were causing the invasion. The YTM should be up further. Why? For last week, up to now, drop. Oh, it's because the other factor concern. The other factor is because the potential war happened in Eastern Europe. So investor will find a hedging instrument. During crisis, they want to find hedging instrument. The US bond is the hedging instrument. So if the money buying the US bond price will up, right? And they will causing the, as the Liao Jinghai Annie just mentioned, we are causing the YTM drop. Understand? Okay, so this is the logic about the market always talk about the YTM up, the stock, the growing stock will drop. But they are, because we are holding other factor constant, but now the market is more concerned about the hedging. And 2 more slides, then we finish today. Okay. This is just mentioned about investors are so concerned about the inflation expectation and concerned about the interest rate hike. But this is the diagram actually prepared by my